It's March 2021, and my guest today is Christian Müller-Glissmann. He's a managing director and senior multi-asset strategist at Goldman Sachs International in London. Christian, welcome to our show.
Thanks for having me.
We will try to discuss the major market issues of last week's, insofar as it's possible to discuss it in 15 minutes. One trend which has grabbed a lot of attention recently is a global bonds sell-off and a rapid increase in bond yields. The sheer pace of this development is quite perplexing because the bond market is the most liquid market in the world, especially the US market, and one would expect that this would keep the volatility low. So what has happened? Why this volatility has increased so much, and how do you understand this bond market rout?
Yeah, no, I think it's the starting point that matters, no? Because last year you had the bond market doing phenomenally well. Obviously, during the kind of bear market and equities, during the recession, you had a sharp decline in bond yields, but also during the recovery, the bond market didn't sell off. So you had essentially a major recovery in equity markets, credit spreads tightened, and the bond market didn't sell off. So there was some delay in response. And I think a lot of it had to do with the investors being quite skeptical about the prospects for growth and still being quite worried about like the aftershocks from the COVID-19 crisis, which would potentially keep inflation and growth much lower. But I think after you had the vaccine announcement and the kind of rollout of the vaccines, I think markets have started to embrace much more the prospects for recovery this year. And I think especially kind of as you start to see better data since the beginning of the year in manufacturing, and you start to see also some price pressures in commodities, you've really started to see the market saying, all right, we have to catch up with regards to bonds.
The way you put it, the bond sell-off seems almost like something natural and expected. But from the perspective of central banks, which are intent on keeping the monetary policy accommodative, the increase in yields actually means the tightening of the monetary policy. So do you expect that central banks will try to limit the bond sell-off and keep the lead on bond yields?
It's a good question. I think certainly central banks don't like volatility. And as you were saying, the move in bond yields has been a bit disorderly. You've definitely seen like spillovers to equities. You've seen spillovers to sentiment. So as a result of that, we're a bit worried ourselves if this bond sell-off can continue to kind of roil markets a bit. And I think central banks, they usually care not just about the level of bond yields, but they also care about broader financial conditions. And I think the interesting thing is that before the sell-off, financial conditions in the US were the most easy on record. They were actually easier than during the tech bubble. So from that perspective, central banks are not really under pressure to do anything because you are still dealing with incredibly easy financial conditions. But I think the fact that this rates volatility is lingering, is having impact on markets, is probably something they're monitoring closely. And I think what's important is also where is the volatility and where is the disconnect to their forward guidance? Because you've seen a combination of things. For example, in Europe, longer dated bond yields were really in the driving seat of the bond sell-off. Whereas in the US, it's been more the belly, like the middle of the yield curve. So to some extent, the market is currently questioning when the Fed is going to start tightening and how much. And that's something certainly that is something the Fed might want to guide against.
Okay, so for most investors, the most important issue regarding bond sell-off are the spillovers that you mentioned. Bond market is mainly an institutional market, but it can influence the equity market, which matters for retail investors. And usually when bond prices go down, equity prices go up. But this hasn't been the case recently. The increase in bond yields has caused a lot of worries that it may somehow end the equity bull market, which to a large extent was built on the edifice of low rates, low yields, forever. What do you think about this?
Yeah, no, I think you're absolutely right. I think you've had multiple years of falling bond yields. And at the margin, that has been a support for equities. So if you now start to see rising bond yields, you have to worry a bit about what that means for equities, and particularly certain parts of the equity market that have particularly benefit. No, like if you think about like long duration tech stocks, for example, like secular growth stocks, you find that they have in particular benefited from this bull market in bonds, in particular last year as well, as real yields were declining so much. So there you see some real headwinds. You've seen the Nasdaq kind of have a significant correction. Also China, which is an equity market which has a lot of tech stocks, but also think about renewable energy stocks, like renewable energy, which has been a very popular secular growth theme, which has really accelerated during the COVID-19 crisis. These stocks are very long duration. They've benefited a lot from the low level of bond yields, and now they've really come under pressure. But generally, when we think about the interaction between bond yields and the equity market, we always look at three things: level, speed, and source of the move. I think the level is still pretty low. We have to be completely honest. Yeah, I mean, like the 10-year Treasury yield is still only 1.6, and we are struggling to still find a kind of positive yielding sovereign bond in Europe. So I think my sense is that the level is probably not a problem yet to really completely derail the equity bull market. In other words, the equity risk premium is probably still quite high in most markets. It has come down a lot, but in a long run context is still quite high. And then we come to speed and the source, and that's a bit more worrying. The type of speed of the moves, as we discussed at the beginning, is certainly something equities don't do well with, but we would expect that to moderate. And the final thing is the source. As long as bond yields increase because the market is embracing the COVID-19 recovery and there's growth kind of being priced in, it should be okay for equities to digest. The bigger threat is that the bond market is repricing inflation risk in a bigger way. And that could not necessarily be a good thing for equities at this juncture.
Why do you think so? One could expect that expectations of higher inflation will keep the real yields low, even when nominal yields rise. That should, in theory, be something positive for the equity market.
Yeah, so there's really like two ways to look at this. You first of all have to think about, are you dealing with inflation expectations that are shifting, or are you dealing with genuine inflation surprises? So far, we've been dealing mainly with the market fading deflation risk and pricing more normal inflation. And that's not a big deal for equities. But clearly what we might be facing in the coming month is that realized inflation will actually start to pick up. And it might actually overshoot, and that can scare markets. And that can impact equities in two ways. First of all, it can push up the bond yield, but without having a lot of growth kind of reasons behind it. And that means that the market might not like it. But also what we found is in periods where inflation surprises to the upside, the equity risk premium often increases. So you might actually have a negative double whammy: bond yields up, equity risk premium up, and that can weigh on the equity market. And what you have to consider as well is that a lot of market cap in equities are actually secular growth companies. Like over the last cycle, the last decade, and last year, growth stocks have outperformed. So they're much bigger proportion of market cap. So they're not really benefiting from better growth. They like cyclical growth. So as bond yields increase and possibly inflation, they are dealing with the rising cost of equity, but they don't really have the positive growth impact on their earnings. So net, it can make a slightly more difficult environment. And generally what we find is that inflation in history, at least when you start to overshoot in terms of realized inflation, is not particularly good for equities at the beginning. Over longer time horizons, like in the 70s, equities were the better choice than bonds because you had a decade of inflation, and obviously equities can to some extent hedge inflation. But I think temporarily from the current level of valuations, we would be worried about really a significant pickup in inflation.
Last year marked a big comeback of retail investors, and the new Joe Biden stimulus package includes checks for households. According to surveys, a lot of this fresh money will again be spent on equities, either directly or through investment funds. Is this something which can support the bull market despite the headwinds of higher yields and higher inflation that we have discussed?
Yeah, no, I think we've definitely seen that type of behavior. I think you had a combination of like savings ratios in the US moving to very high levels. Part of that is the checks, but part of that is also the fact that people cannot consume. No, you have to be aware, like you cannot go on holiday, you cannot go out much. So it's not just the fact that you've had people receive the checks, but also that you couldn't spend. And as we start to see economies reopen, we would assume that spending does pick up. People go on holidays, people kind of potentially spend a bit more because they want to kind of catch up after like a bit of a lost year. And that should actually mean that savings ratios come down in a more less speculative way, that it kind of goes towards equities, but they come down because of a more traditional way. But to your point, I think retail demand for equities has been very prevalent. We see that in ETFs, like concept ETFs. We see that in all kinds of strategies and flows. And we've actually seen one of the largest inflows into equity funds on record in the last 2 months. So the question is, how much more? My sense is retail has already been a significant driver of demand for equities, which is to some extent why we are starting to consolidate a bit, because valuations have been very high. And you are starting to see the first headwinds from higher rates. You're starting to see the market having to reassess how much growth we're really going to get. So my sense is to expect an incremental boost to equities from the demand from retail is probably too optimistic. But we would assume that the demand for equities will continue, where people will think about what really the bonds can do in your portfolio. And we have still a lot of money market funds out there, which are looking to be reallocated. So all in all, I would agree with you, but I wouldn't necessarily say that it will be a major wave of demand that will head towards the equity market. It certainly should cushion any type of drawdown. So already in our conversations, as we start to see the Nasdaq and certain popular retail favorites come under pressure currently, we start to see investors asking if it's a good time to buy the dip. No, and I would assume that retail will be part of that.
You have mentioned that in the United States, a lot of the bull market was driven by growth big tech companies. And actually, this was a global phenomenon, but because the prevalence of such companies in the US, it was more visible there. And what about Europe? European stock markets, which are dominated by cyclical old economy companies, have underperformed over the last year. Do you expect that their fate will change this year and that they will overperform among expectations for recovery? In other words, is Europe better positioned to benefit from the recovery?
Yeah, I mean, that's our view. I think we in our asset allocation have been relatively pro-risk. So overweight equities, underweight duration. And we've been going towards the more cyclical, towards the more value parts. And Europe ticks a lot of boxes there. I think you said it exactly right. There's a lot of traditional old economy companies and sectors. So you have energy, you have financials, you have cyclicals. And all of these areas, they should benefit from the COVID-19 recovery continuing. And what's most important in terms of relative performance is their very short duration. So whereas these tech stocks, they are suffering from higher bond yields, what we find is that these cyclical value type stocks, they can buffer those because their equity risk premium comes down as bond yields increase because of better growth. And in a lot of cases, by virtue of them having high dividend yields, a lot of their present value is in the next few years. So as the cash flows pick up, they benefit and they don't suffer necessarily from like expectations in the future being discounted much more with higher bond yields. Yeah. And all of that to us is likely to be more valuable. And we've definitely seen markets like Japan, which is also very short duration, be an incredibly strong performer. And we would assume that Europe has been a bit of a laggard, but it will close the gap. And we've certainly seen that in the last few weeks, where I think Europe has kind of outperformed the US quite a bit.
The increase in bond yields that we have discussed was partially driven by increasing inflation expectations. This, in theory, should push gold prices higher. But this is not what has happened. Gold has been losing value ever since August. Do you think that gold has lost its status of hedge against inflation?
Yeah, it's a very good question. I think gold often perceived to be, people often perceive gold to be the obvious inflation hedge. But you have to consider it's an expectation-driven asset. No, and what we've seen is that inflation expectations have increased materially last year, and they pushed down real rates at the time, and it boosted gold. But in the last 2 months, we've started to see real rates move up. And as a result of that, like the kind of gold story has like a significant drag from these higher real rates, because to some extent, higher real rates are supporting the dollar. And you could argue that gold is denominated in dollar. So the question going forward is really like, where will real rates go? And in particular, where in the curve? Because the big problem is that gold historically traded very correlated with the longer dated real rates, like 10-year TIPS yields. But you could see a situation where the real yield curve will steepen significantly, and the front-end real rates will actually go more negative. And our view would be that eventually the front-end real rates going negative will continue to weigh on the dollar, because the dollar has been a bit stronger in the last few weeks. So the dollar will resume its downtrend, and that should help gold as well. And at the margin, we would say that gold eventually will continue to do well. What I would say, though, is like gold, if you look in history, in the last 100 years, in periods of inflation, had a bit of a mixed track record. So like, for example, in the 70s, it did really well. But in the early 80s, it came under a lot of pressure. And it really depends a bit on the central bank reaction function. It depends on to some extent, positioning. Positioning was very long gold. And what we actually found is the much more reliable inflation hedge is actually the broader commodities complex. Oil, metals, these areas, if you look at historical correlation with inflation, is much more consistent. The same is true with real assets, like residential real estate. We actually found much more close relationships with realized inflation than with gold. I would still say it has a role if inflation really gets out of control. And as I said, in the next few months, we will probably see a significant pickup in realized inflation, not in expectations. And that could give a bit of a boost to gold. But unfortunately, gold has a bit of a historically mixed track record as an inflation hedge.
There is not much history behind Bitcoin, but I was wondering whether actually it is Bitcoin that has replaced gold as the ultimate inflation hedge. One could draw such conclusions from Bitcoin prices development over the last couple of months. Would you say that now Bitcoin has become the ultimate uncorrelated asset?
It's a really good point you make. I mean, the interesting thing, of course, on Bitcoin is there is no real history. So Bitcoin has never seen inflation because it didn't exist. So to talk about it being an inflation hedge is difficult because you don't have history. But you're absolutely right. I think up until 2 months ago, I wrote a bit of research on Bitcoin, and what we found is that it's been very correlated with equities, with copper, and it's been very negatively correlated with the dollar. So if you construct a portfolio, you always look for uncorrelated assets. But last year, Bitcoin really traded very correlated with a lot of other assets. So as a result of that, we've always been a bit skeptical about the role Bitcoin can play in a portfolio. But you said it absolutely right. In the last month, that has changed. Bitcoin has really started to decorrelate from equities, especially from NASDAQ. Before it was very correlated with tech. It's decorrelated from the dollar. And it starts to have its own dynamic. But unfortunately, it's only 4 weeks of data. So like to really get conviction, it's probably not enough. But what we've said at the time, and I continue to say, is we think that cryptocurrencies, the blockchain technology will definitely continue to grow and have a role in finance, in banking, and probably in investor portfolios in some shape or form. But I think it will take time.
So hopefully we'll be able to meet once again in a year or so and discuss what happens during this time. Our guest today was Christian Müller-Glissmann. He's a managing director and senior multi-asset strategist at Goldman Sachs International in London. Thank you, Christian.
Same for me. Thank you.